Hi everyone. Sentiment on Wall Street remains moderately positive. Three benchmark indices managed to maintain upward movement despite crucial economic reports of last week. Investors factored in a 75 basis point rate hike by the Fed a long time ago, so after the Fed raised the key rate by the exactly predicted amount, it didn't stir up volatility. Market reaction to the extremely weak US GDP figures for the second quarter, which formally signaled a recession in the country, was also rather muted. It appears optimism in the stock market is mainly driven by the earnings season. The already published quarterly reports have turned out to be upbeat. More than half of the S&P 500 companies have posted results so far, with 70% of them beating consensus forecasts for estimated earnings and revenue. This is why it's hardly surprising that the main US stock indices have stayed in the black of the week. The new week also kicked off on a positive note. Apart from earnings reports, US macroeconomic stats will be in the limelight. Speculators are looking forward to the release of the July non-farm payrolls report. Watch our video review till the end and leave your feedback down below. Let's start. At first, trading on Monday was rather sluggish. However, it got more buoyant later amid positive US PMI manufacturing data for July. The US manufacturing sector expanded slightly less compared to the previous month, lodging the lowest level in the last 2 years. Yet it exceeded market expectations, which fueled optimism on Wall Street. This week, traders are awaiting fresh economic and earnings reports. Judging by the results of the recent reports, inflationary pressure on companies in the world's largest economy may ease in the near future. In addition, upbeat quarterly results are likely to eclipse the disappointing GDP report revealed last week. However, as already mentioned, investors were taken aback by the negative GDP report. They are so tired of pessimistic data, so a ray of hope, which is the positive earnings reports, brightened up the sentiment in the stock market. Speculators also paid zero attention to the Fed's key rate hike. Some analysts were puzzled by such reactions. Last week was rich in events. Despite the publication of important macroeconomic data, the equity markets remained calm. To some extent, stocks avoided volatility thanks to the Fed's meeting. The regulator raised the interest rate in line with the forecast. Jerome Powell also said that the Fed keeps inflation under control and there is no recession in the country, only a short-term slowdown. Thus, investors have realized which way the wind is blowing. According to Powell, market participants should not fear a recession, as the latter indicates a slowdown in inflation. If this scenario comes true, the central bank is likely to stop aggressive monetary tightening. For this reason, optimism has remained strong over the week, with the main stock indices rising higher. The Dow Jones ended the week with solid gains. It also climbed significantly in July. The Dow jumped by 6.7%, notching the best monthly results since November 2020. Other major stock indices demonstrated even better performance. The recession fears have subsided. The Fed is likely to switch to a less hawkish stance in the near future. Speculators are now closing their short positions amid strong earnings reports. If this really trend reversal, unlikely, what is happening now looks more like a bull trap. Usually traders have to deal with the predictions and expectations. This is why they are now anticipating some positive events. However, they seem to turn a blind eye to the fact that the interest rate is rather high. Besides, the Fed pledged to hike it further until inflation starts declining, so the likelihood of new rate increases is quite high. Inflation is still rising and there are no signs of a slowdown. On top of that, a recession is looming on the horizon, whether traders want it or not. The S&P 500 index has scored the biggest weekly and monthly gains. In July, it soared by 9.1%, lodging the best results since November 2020. Its rise was facilitated by a combo of strong earnings reports and expectations of the Fed's less hawkish stance. After an impressive rally, the S&P 500 index seems to be losing steam. It's now growing moderately. To resume a rapid increase, the index needs new drivers, like positive economic reports. On Friday, a revised NFP report is on tap. As Powell mentioned this report in his speech last week, market reaction to this data is likely to be more pronounced. The Fed chair has repeatedly stated that the watchdog has the opportunity to tighten monetary policy more aggressively thanks to a strong labor market. Judging by the technical indicators, the S&P 500 is lacking drivers for further growth. During the current week, it's likely to consolidate in the range of 4,000–4,180. The pivot level is located at 3,950. If the index advances above this level, it could start a long-term rally, lasting until the FOMC meeting on September 21. If it drops below 3,950, the bears may push the price to 3,900 and 3,860. These levels separate a long-term bullish trend from a bearish one. A breakout of these levels will put an end to the bullish trend of the S&P 500 and the entire stock market. The heavy tech NASDAQ 100 jumped by 12% in July, ending the best month since April 2020. As the earnings season is in full swing and new reports are highly likely to be upbeat, the NASDAQ 100 could approach new highs. However, its further rally will also depend on the sentiment of stock traders regarding the U.S. economic prospects. There will be lots of new reports in the coming days. About 150 companies from the S&P 500 index are going to reveal their quarterly results. Last week, such tech giants as Amazon and Apple surprised investors with better than expected performance. The world's largest online retailer reported a $2 billion net loss in the second quarter, as it took a massive write-down on its investment in electric vehicle maker Rivian. At the same time, its revenue rose in annual terms, which led to a 10% increase in Amazon shares. Apple released earnings for the second quarter that surpassed forecasts for both revenue and profit. Apple's net profit declined in annual terms but exceeded analysts' expectations. After the report, Apple's stock lifted up by 3.3%. The company is dealing with a number of challenges, including inflation, which has hit consumer spending. Apart from that, the epidemiological situation in China has also affected the company's sales and production in this country. Apple will launch new devices in autumn, for example iPhone 14 and the Apple Watch Series 8. This event will hardly impact the company's profit in the fourth quarter, as the products are announced just a few weeks before the end of the quarter. However, such news may boost its revenue in the first quarter of next year. Subscribe to our channel and keep close tabs on market developments. Please leave your comments down below as we work for you, creating new video reviews for you every day and week. Your feedback is important to us. See you.